All right, guys, let's get started here. Class 4 of the day trading course, and another fantastic day in the markets. Just over $3,500 profit for me, which puts me up about $28,000 in the last 8 days. So we're in a really strong market, and one of the things that's important to recognize when you're looking at charts is how strong is the daily chart. So today we're going to talk about an introduction to candlesticks, candlestick formations, different types of charts, and then we're going to move into learning how to read daily charts and finding those big pockets and essentially learning how to identify a strong daily chart. All right, so today on the agenda, we're going to look at candlestick charts. There's a typo there. Understanding what a candlestick chart is, and then we're going to look at specific candles, hammers, dojis, long body candles. We're going to look at different charting time frames. We're going to review some technical indicators, and we're going to talk about triggers, windows, and support and resistance lines. This is some really important stuff, especially the triggers and the windows, because that's going to be how we identify strong daily charts. And as I sort of already hinted at, this is important because the potential of a stock is often defined by its daily chart. Now, we're always looking at stocks that have strong catalysts and a reason to make a big intraday move. But, at the end of the day, if you have a very, very weak daily chart, it's never going to help the setup. There are times where a very strong catalyst will override a bad daily chart because the news is just so good. But the chart's always going to be, it's always better to have a good daily chart, and those stocks are almost always going to be faster to respond to the breakouts because more traders recognize the potential. So, as you guys probably know, although we haven't covered it yet, so if you know, it's only because you're generally familiar with the market, stock charts are comprised of candlesticks, and each candlestick represents the price action within that set period of time. So if you're looking at a daily chart, each candlestick represents 1 day in time. If you're looking at a 1-minute chart, each candlestick represents 1 minute in time. And we can choose pretty much any time frame we want, from 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, 6 minute, 7 minute. But there's particular time frames that are well respected and utilized by day traders, and that's the 1 minute and the 5-minute chart, and of course the daily chart. Some traders use 15-minute charts, some use 60-minute charts. Those are also popular time frames. And the 2-minute chart can be popular among certain traders, but by far the most popular is going to be your simple 1-minute and 5-minute time frame. All right, now there's also different types of charts. Candlesticks are only one type of chart. There's also bar charts, line charts, Heikinai charts. There's a number of different charts that you could choose from, but I choose candlestick charts. It's what I've always used, and I think it is the most popular type of chart for day trading. Now this is what a bar chart looks like. You can see this is a little foreign. This doesn't look the same as what we're used to looking at. It's a little bit different. And then here's a line chart. You see this on the news a lot, like on TV. They just show you the line chart of the overall market. It's really not that helpful in terms of understanding the price action today of the stock. And this is the same time frame, right? So you could either look at this line chart or you could look at this candlestick chart. Now this to me gives me so much more information than the line chart. In fact, this tells us 4 pieces of information, and we'll look at each of those 4 pieces in a minute, each single candle. So as day traders, we rely very heavily on stock charts. And in that sense, we're technical traders. Stock charts are a form of technical analysis, whereas fundamental analysis is when you look at the fundamentals of the company, of the sector, of the overall economy, and you use those types of pieces of information to draw conclusions about the future strength or weakness of the stock. And that's fine, and that's especially good for investing. But that's not really good for day trading because the market can be so irrationally strong. despite really, really poor fundamentals, stocks can move very, very quickly. So traders that spend their time focusing on fundamentals, they'll say, well, oh my gosh, this stock should go down. It shouldn't be up this high. Did you read their earnings? They're horrible. And, all of the day traders are thinking those don't matter right now. Right now, everyone's jumping on the momentum. This stock is moving up. It's going to keep moving up. The fundamentals will matter eventually, but right now, this is a technical squeeze. Momentum traders are on it, and the fundamentals don't matter. So day traders are technical traders just by our nature. So we're looking very closely at candlestick patterns to try to interpret what they mean about the past price action and what they might be suggesting about the upcoming price action in the next few minutes. Right? If you know what's going to happen 3, 4, 5 minutes ahead of time, you could do really well in the market. Right? If you could time travel backwards, you could do incredibly well. But we can't do that. So what we can do is we can take the past price action and try to use that to predict what's going to happen moving forward. All right. Now, the basics of a candlestick are that they each give us 4 pieces of information. They give us the open price and the close price of that time period. They also give us the high and the low of that time period. Sometimes the open and the close price are the same. Sometimes the high and low are the same. That would be a candle that is basically just one price if it was the same price for all. Sometimes the open is the same as the low. Sometimes the close is the same as the high. So these prices are sometimes the same, but oftentimes they're different. And when all 4 prices are different, you're going to have an upper shadow, which you can see right here. This is the top of the candle wick. That upper shadow goes up to the high. And you have the lower shadow, the lower candle wick, that goes down to the low, down to the lowest price. And then on a green candle, the open time, the price of that candle's open is right here at the bottom, and then the close is at the top. So we opened low, say at $9, and we closed at $9.05. We hit a high of $9.07, but we closed at $9.05. Maybe we dipped down to $8.98, but we came up and then closed at the top. In contrast, a red candle opens at the top, right, and then closes at the bottom because it's going down. So it opens at $9 and closes at $8.90. Had a low of, say $8.88, but closed just above that, maybe squeezed up for a second and then came down off those highs. So we call these upper shadows candle wicks, and this here is the real body of the candle body. So hammers and inverted candles. This is a particular type of candle. It's a candle formation. It's a candle shape. What it is a candle that has a long, in the context of a downward momentum trend, this candle is going to have, as a hammer, a long bottoming tail. This wick is called a bottoming tail, and it has a small real body right here. So it kind of looks like a hammer, like this. And the concept there is that this candle is hammering out the bottom of the move. This hammer candle in the context of sideways price action is not very significant. It's significant in the context of this sell-off. An inverted hammer is an upside down hammer, right? And this is important in the context of an uptrend. Okay, in sideways price action, it's not that relevant, but in this context here, it's very relevant. Okay, so why is it relevant? What is this candle telling us? The fact that we have this lower wick right here tells us that the price dropped down during this candlestick period. The price sold off. Okay, so that's bearish. But what's bullish, and what tells us that we might be hammering out a bottom, preparing for a potential reversal, is the fact that buyers pulled the price back up, so we ended up closing up here well above the low of that period. Okay, so we open, we drop down, and then we close up. Now, this is a red hammer. A green hammer would be even more bullish because we would show that we actually closed above the open price of that period. Okay, so then with the inverted candle, this shows a reversal indicator because you have the buyers, they squeeze it up to a high here of $43, and then the sellers push it back down. So at the end of this candle period, the sellers have dominated. They've conquered the buyers by bringing the price all the way back down to here. Now, it doesn't necessarily mean the next candle will be the reversal, but in this case, it was pretty close. And it was also pretty close in this case as well. And in both scenarios, the top of this candle wick was the bottom or the top of the move. So that price right there would be a good stop if you're getting in for a reversal. Okay, so a hammer candlestick is critical when it occurs at the bottom of a sell-off. That's the time we want to look at it. All right, hammering out that base, preparing for a possible reversal. It's a reversal indicator, but it's not confirmation. Okay, so we look at it just as an indicator, and then we're going to look for confirmation. Confirmation typically will be the first candle to make a new high. So this green candle right after the hammer made a new high. That's the place I would usually get in. And we'll talk about this in detail when we talk about the reversal trading strategy. But just for right now, understand that this is a reversal indicator. Confirmation is the first candle to make a new high with your stop at the bottom. So here, you're now short on the first candle to make a new low, which is this red candle, with your stop at the high right up there. Another important candle formation is a doji. A doji candle opens and closes at almost the exact same price. All right, now typically dojis will have an upper wick and a lower wick, and then they close flat, although they don't necessarily need to have a tall upper or lower wick to be considered a doji. As long as the price opens and closes at almost the same place, it'll be a doji. So we've got doji here, we also have one here, we have one here. This one here with just the bottom wick is also a doji. These two are kind of dojis. So this again is a reversal indicator. What these candles are showing us is that there's a battle going on between the buyers and the sellers. You know, the buyers take control for a moment, the candle goes up. Then the sellers take control and the candle price drops down, and then the buyers come back in and we close flat. All right, so just in the case of the hammers and the inverted hammers, we're seeing that struggle where we drop down and come back up. Now, on the other hand, a real body, long body candle right here that has this big solid green bar, there's not a lot of battle going on there. The buyers are in control. So what this chart is telling us is who's dominating. Are buyers controlling this stock or are sellers controlling it at this moment? And these shifts in momentum are important to recognize because these are possible exit indicators and possible entry indicators. And what we have right here, we have this first little push up, and then we have this dip back down to our moving average, and then the buyers take control with these 4 green candles, increasing with peaking volume up here at the top. Okay, so volume is an important indicator as well. Then we have this doji at the top with a couple of sideways candles. Sellers are in control right now, but not completely. We have, battle here, a little bit of a battle here, and then very quickly, buyers come back into control and they push the stock back up. All right, so a doji is a candle of indecision. And again, a doji that occurs during sideways price action doesn't mean anything really because sideways price action is already indicative of indecision, right? So it's only when the price is strongly going up that indecision makes us a little nervous. We want to see the stock going up with no indecision, just continually going up, 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 up. So when we start to see that weakness, whether it's in the form of a doji or an inverted hammer, it's an indicator that the trend may be getting exhausted near the top, or in the context of a sell-off, that hammer or doji at the bottom, that the trend downward is getting exhausted. You don't want to see that indecision. Now, it's important to note that indecision is worse during an uptrend than it is during a downtrend, because when a stock is weak, it's sort of inherent that there is some indecision involved. Even though the stock is being dominated by sellers, The fact that you get a little bit of buying, but it's still a little indecisive, that's just still weak, right? That's still weakness. So that's actually good if you're short the stock and you want it to keep going down, and it's not always the best indicator of a possible reversal. So sometimes on a downtrend, you'll see a lot of hammers in a row or a lot of dojis in a row because you're still you're weak, popping up just a little bit, but then indecisive and then selling off more. Whereas in an uptrend, that weakness that's reflected in a doji or an inverted hammer is more significant because during the uptrend, we want to see enthusiastic buying. The people are jumping in this stock. They want to see it keep running. So we want to see those big green candles getting bigger and bigger, and then it usually peaks at the top, and that's when we get that quick reversal back down. Okay, so now here are a couple of long body candles. These are showing, very clear control by the buyers, right? Those big green candles, the buyers are in charge on this stock. They're in charge until you get this doji up here. So if you're a new trader and you've never seen a doji, you might not recognize that this isn't a safe place to buy. We've got two dojis in a row. We've got one that's almost kind of an even cross, and then we have this one here that's got this long top. Okay, so, and this is called a gravestone doji. It's ominous, right? You've got this sort of long top right up here. It's not good. And the thing is, I would never have bought when this doji broke the high of this doji because I don't want to buy a doji candle. I don't want to buy when the previous candle is a doji. At this point, we need a pullback. We need a consolidation. We need a flag. And then we can rally for the next move up the way we saw right here on this one, right? This is a doji. Then the second candle broke the high, but I wouldn't buy that, even though it was a candle making a new high, and it shows, you might think, continued momentum. This to me is a fake out. I want to wait for it to reset and then get in down here on the bull flag. That's a proper pattern. But often new traders will chase these setups, seeing it going up, and so maybe they think I'll buy the next candle to make a new high, but that's not a good setup when the previous candle is a doji. Okay, so the same with red candles. These are candles that show real control either by the buyers or the sellers, showing extreme strength or extreme weakness. So what we're doing is technical analysis. We're looking at these candlesticks and we're trying to draw conclusions, interpret what they mean. And so, we could be looking at a line chart, but we feel, of course, that candlestick charts give us more information. And they do. They give us more information. And then just based on the open, close, high, and low price, based on those 4 data points, we're able to draw conclusions like the stock is strong, the stock is weak, it's indecisive, it's due for a reversal. And you wouldn't be able to gain any of that information from a line chart alone. You just couldn't. Right? So we're using these charts for technical analysis. And then as pattern traders looking for our flat top breakouts or our bull flags, we're going to be looking for technical breakouts on the chart. These are places where we expect to see many buyers and many sellers. And the volume will confirm that the technical breakout is happening. All right, that tells us that we're not the only person who is looking at this setup, that thousands of other traders were looking at it at the same price, and that's why we're getting that clean resolution and that big breakout. So what we're going to do is we're going to use the charts, use the candlestick patterns. Right? One candlestick by itself isn't a pattern, it's just a candlestick. It could be an indicator of something. But when we put together multiple candlesticks, we form patterns. The bull flags, the flat top breakouts, etc. So we're going to use those patterns in the candlesticks to find our entries, establish possible profit targets, max loss, stop out points. And that's going to be the basis for our risk reward analysis on every trade we take. Now, we can use arbitrary stops like a hard 20-cent stop on every single trade. And that's fine. We're just going to cap our max loss. And sometimes that will mean we're stopping out not at the very bottom of a candle, but halfway down, because if we go all the way to the bottom, it's a 40-cent stop. So we say, well, we can't do this with a 40-cent stop. We're just going to use an arbitrary stop But you have to recognize where the proper stop is on the chart. Even if you choose not to use it for whatever reason, knowing the proper stop is important. So technical analysis versus fundamental analysis, as I already sort of indicated, we focus on the technicals, and we don't want to get into the game of justifying why we're holding a stock because of fundamentals. Saying, oh, well, I was short Nike, this stock should be coming down. I've heard so many people get into this, and it's kind of like a pet peeve, because that logic has no place in day trading. Oh, they had horrible earnings. It's someone who's trying to do analysis on, the corporate documents that the company's released. Meanwhile, the stock is up 15%. So, obviously there's some lapse there in your interpretation of the fundamentals, because the technicals are saying the stock is still going up. And it's very frustrating for fundamental traders to have such a strong opinion on a stock and have it do something so different. And we see this, not just on the day trade level. I mean, we certainly see it with day traders who will take bad trades or try to take trades and justify why they're in the trade because of fundamental. A stock that's gapping down on good earnings, what they think are good earnings. Well, they'll buy it because the earnings were good, but then the stock keeps selling off, and they don't understand why. Sometimes it doesn't make sense, and you just have to follow the price action, and that means adhering to your stops. If you take the trade, you have a max loss. You don't get into a trade purely for fundamental reasons. You always need a setup, and the setups are a technical setup. That's when you're a day trader. If you're an investor planning on holding for 8 to 10 months or whatever it might be, the intraday technicals are meaningless, really. I mean, you don't care about those. You're probably not looking at those. That's when you are looking at the bigger picture. And sometimes you're wrong. We've got activist investor Bill Ackman, who lost a tremendous amount of money on his JCPenney's investment, and I think he's lost a lot of money on his Herbalife investment. He did a lot of fundamental research, and he just happened to be wrong on those. But he's also had some other investments that he was very, very right on, and he did really well. And of course, at the end of the day, is his percentage of success and his profit-loss ratio strong enough to keep him in business? And so far it has been. But that's different because that's investing, and what we're talking about is trading. So in that sense, what we like to say is that we trade tickers, not companies. So today I traded JAGX and STAF and BLPH. And, I might know the sector and I might know the company name, but I really don't know that much about them, and I don't care about them. I don't care about them in that sense. I'm focused 100% on the technicals today. I'm not getting married to these stocks. I'm not investing in them. I'm trading them. And it's a very important thing to be able to differentiate trading and investing. Very different strategies. And when you try to combine them, you can really run into trouble. So you really want to make sure you separate those two strategies. This is what my charting layout looks like. And you've already seen this when I pop out of the PowerPoint presentation and you can see my chart. This is pretty much what it looks like. I've got the daily chart on the bottom. It's kind of small, stretched out wide, so I can see a good 2 or 3 months of price action. I've got volume down there on the bottom. And then up here, I've got my 5-minute chart and my 1-minute chart. Now, on this particular chart, I have a couple of indicators, which we'll go over in a second. But right now, the only ones I'm using, I've gotten rid of this one, which is the MACD. It's helpful sometimes, but I don't really use it. Right now, we just have my moving averages, my VWAP, and the candles. And what my focus is it's on the candles. So this right here is what the computer I'm on right now, that's what it looks like. It's 5 monitors, and I've got up on the top my charts. This one has level 2 with time and sales. I've got my trade ideas scanners. So this is one stock, one company right here. The daily, the 5-minute, the 1-minute. And then each of these charts are 2 companies. So we've got 2 stocks. The daily, the 5-minute, the 1-minute, daily 5-minute, 1-minute, daily 5-minute, 1-minute, daily 5-minute, 1-minute. And then this is the overall market, the SPY. Okay, so I keep an eye on the overall market just to have the bigger picture. Sometimes I like to refer to that. I've got the chat room down at the bottom, and of course I'm screen sharing this screen right here up at the top. So that's 5 monitors, and then in between these 5 monitors, or in between these 3 and these 2, I have 2 monitors, which is my broker. So I can log into SpeedTrader, Lightspeed, SureTrader, Ameritrade for my simulated trading account, so I can access the free charts. And then I have my Excel doc on that computer, and I can do emails and Twitter and stock twits and stuff like that. And then over on this far side over here, I've got 2 more monitors. So over here, and then my laptop, which you can kind of see in the background here on the video. That's the far side. So it kind of wraps all the way around. So we've got 2, 4, 6, 8 monitors and 3 laptops. So the middle laptop and the far laptop each run 2 monitors above them, and this laptop here runs the 2 above them and these 2 over here that are in the middle. So that's basically the way my setup is. You can kind of see it here as I turn the camera a little bit. This is for folks that are going to be watching the recording. But in any case, what's important for me is to be able to have a close eye on usually 3 to 4 stocks. So, as I kind of orient myself in this direction, I'm always looking at this stock up here at the top. This is usually the one I'm trading. And then, of course, my broker is right next to it, right in this area, basically. And then these 2 I'm keeping a close eye on. This is usually my second and my third favorite setups. Fourth favorite setup here, and then the one that I kind of only sort of care about is going to be over here with the overall market up here. Now, this is helpful for me to be able to watch this many charts at once, even though you might think it's a lot. And of course, having 3 charts for each stock is not totally necessary. I don't need to see the entire daily chart once I've looked at it once, but it's easier for me to keep it up. That way I can just look over, refer to it, and when I'm looking at a ton of things, I can say, yeah, that's why I like that. The daily chart looks good. I like it, works, and that sort of thing. So, for a newer trader, if you don't have this type of layout, which most people, I suppose, might not have, you're going to be limited to, your monitor space, and you'll have to make do with a little bit less, maybe than what I'm using. So some of the things that you could drop, you could probably consolidate. You could probably drop one of these, and you could probably have 2 charts in this area and not use the level 2 here, because this level 2 is not going to be that helpful for you. It's just really for folks in the chat room that I can make examples and explain what I'm seeing. So you could probably lose a monitor, and you might not need a whole monitor for running the chat room, stuff like that. But this is the core of my trading, plus the 1 screen for my broker. Now, whenever I'm trading, of course, I'm looking at key levels, and I want to anticipate those breakout levels on the chart. Those are going to be the places where volume comes in. And that's ultimately the biggest challenge, is to anticipate when the volume will come in, so we can get in before it really kicks in, but also, not too early. If we're in too early and then we don't see follow through, we're just going to be sitting there waiting, and that's risk exposure, time in the market. So, and then on the other hand, if we get in late, we're chasing the move. So it's finding this balance between being too early and being late. It's that key level. So learning to anticipate the apex point, really. It's the breakout point, the point where this stock has to either go up or go down. And so that's kind of what I've mastered, is finding that apex point so I can get into a trade and get out of it as quickly as possible. The truth is, the majority of the time, my trading account is all cash. My average trade being 9 minutes long during that SureTrader challenge. Today, with 3 or 4 trades, that's maybe 30, 40 minutes in the market, and the rest of the day all cash. And yet, in the last 2 weeks, I've made almost $28,000 on a $40,000 account. So, I'm starting to get close to 100% gain, doubling that account essentially in less than probably a month if this trend continues. So that's that's pretty powerful. And you don't need to be in the market all day long to make it happen. You just need to know the right place to get in. So it's very precise, surgical, if you will. So we're going to talk a little bit about technical indicators. What are technical indicators? They're designed to give you context for the current price action. And really the only reason we use them is to help us understand both the context and maybe give us a little indication of future direction. But you can never rely entirely on technical indicators. Instead, I use them to confirm what I already suspect. All right, now technical indicators can be very complex. There's some complex formulas, and I've written some. We have a couple that are available that we'll talk about in a few minutes, but generally speaking, they're very complicated. And what they do is they take the price. So they'll take the open, the close, the high, the low, of the last X number of periods, and they use that to, calculate something. So maybe they're calculating like a moving average, or they're calculating, the strength or weakness, the rate of change, these different things. The problem is these indicators are always going to lag just a little bit behind the price, because the price has to happen first in order for the indicator to have anything to calculate. So it's always just lagging a little bit behind. So some of the indicators that are helpful are ones that are oscillating. So you can start to see them moving from being really weak and oversold to, more overbought. But indicators that are supposed to be like really kind of jumpy and quick to give you an exit or entry alert are often not that helpful. So this kind of gets into the search for the Holy Grail. And I have met a lot of traders, and there's a movie, I can't remember the name of the movie now. It's a stock market movie from a long time ago. It's an older movie. And the guy is like a computer wizard. And what he's trying to do is create an algorithm to profit in the market, basically. He's trying to create this custom indicator type of, formula that can just return profit, return profit, return profit. And although there are certainly hedge funds that have, this type of thing that works for them, it works on a scale that is beyond the reach of any retail trader, because probably none of us have multi-million-dollar accounts with a server, 4 feet from the NYSE exchange. We don't have the capability of doing high frequency trading and scalping pennies off, these news alerts, or getting in and then putting shares on the ask. And we're not market makers. So, we're not in that position to have the power that some of these institutions have. So the hunt for the Holy Grail, it's something that I got into a little bit when I was a beginner trader. I thought, I was confused by charts, and what I wanted were clear entry and exit indicators. That sounds simple. And can it take the form of a green arrow and a red arrow? That's where I get in, that's where I get out. And if I simply follow it, I can make money? Because I was struggling so much to understand, charts and why things would work. I just wanted to delegate some of that to, someone other than myself, like the computer, basically. And, I worked on trade ideas scanners where I could formulate them to be extremely strong. You can do back testing where you'll back test a scanner over like 60 days or whatever it is, and it'll tell you if you took every single one of those trades, how much you would have made, and then you can calculate the commissions, the share size, slippage, and it'll tell you this is how much you would have made. So, I did that, and I got a scanner that was returning like an amazing, profit curve, equity curve. It was fantastic, and I thought, look at this. This is telling me if I traded with 2,000 shares, I'd be, making a ton of money. And I didn't develop the scanner. What I started when I was working on this was developing a scanner based on the patterns that I thought would work, what I was making money on, like the bull flags or the opening range breakouts. But when I built that scanner and back tested it, the results were horrible. So what I ended up doing was just kind of tweaking the results, or tweaking the filters until I got the results that I liked. I let it, sit on the back burner for a month. I come back, I test it again, and it was a total failure. It wasn't good anymore. So I said, that's weird. Well, I made some adjustments. I tweaked it, I fixed it, let it run for another month, got it till it was looking good, and then let it run again, and it came back again as a failure. And what I realized I was doing is I was actually, like, the market was a mold, and I was taking a mold was like a face, and I was taking this piece of clay as a scanner and smushing it on here, adjusting the filters until it fit like just perfectly. Returned a perfect test. I take it off, I put it down for a month, I put it back up, and then the market's changed. So now the market's like this. I put my mask on, and it doesn't fit. What I was doing is I was actually, developing a scanner to return an amazing back test, but it wasn't based on something that would continue to be profitable. It was basically to match a certain combination of winning trades that had occurred during those last 60 days. And then once you took those winning trades away, the scanner didn't work anymore. And I can assure you, I spent a lot of time working on this. I mean, I lost a lot of hours on this. And I worked a little bit with the folks from Trade Ideas on some of these scanners at various points, trying to return, get ones running that had good back tests. And it was a waste. It was a waste of time. I'm sure I learned. I have the story to tell, so we have something out of it. But I certainly don't have a algorithm and some black box trading account that's making me $10,000 a day while I watch Law and Order. That just didn't happen. Didn't work out for me, and I don't think it's going to work out for any of you guys. So hopefully that doesn't burst your bubble. But it's just to say that technical indicators and trying to create amazing scanners based on indicators, and you can kind of get overloaded by it, and you can get yourself kind of lost trying to do all this. So what we're going to do is set up charts in the most basic way possible. We're going to go with basics, and we're going to look for are not as much of the the technical indicator type of confirmations. The confirmations we're going to be looking at will be chart patterns, candlestick patterns, like the bull flag, and then the confirmation that the flag is resolving, which will come in the form of lots of buying volume. All right, so to set up your charts, you're going to use the 9, the 20, and the 200 exponential moving averages and volume. That's it. If you like doing reversal trading and you like pullback entries, you can use the VWAP, the volume weighted average price, and you can use Bollinger Bands. Though I find those both helpful for that strategy. Volume bars, these are visually showing us how much volume occurred during a candlestick period. Again, these are green only because the candlestick was green during that time, or red because the candlestick was red. It's not to say that this is all buying volume or it's all selling volume. It's just correlating with which direction the candle was going when this took place. And that's a setting you can change. If you want them all to be gray, they can all be gray. But it is helpful to know that we had peak volume on the candle going up, or we have peak volume on candles that are going down. If we have peak volume on candles that are going down, that's telling us, sellers are definitely in control. All right. And so these are our moving averages. Moving average is very simple. It's the average price over a set period of time. So a 9 moving average is the average price over 9 periods. Exponential means we're heavily weighting more recent price action versus older price action. And what that's going to do is it's going to make the moving average move a little bit faster. It's going to move faster because the recent price action is more important. So if the stock drops quickly, even though the average from maybe 9 periods ago was like this, with the exponential, the moving average is going to drop faster because we're weighting that recent action more heavily. So what you see here are these ribbons, basically. We've got our 9 moving average, our 20. On this chart, we have a 50. And then right here, we have our 200. The 50 is a moving average I use mostly on the daily chart. I don't use it on my intraday charts. All right, and what we're looking at here is the importance that these are in a ribbon. When moving averages are crossed, when they're all crisscrossed, it's telling us the price came up, came back down, or if we're coming up into a moving average, obviously the stock has been weak. So having this ribbon where they're all open, can be a little bit, that's indicative of strength. And you can see here in my eSignal indicators or chart area, you just go in, you can choose exponential or simple. Simple moving average won't weight them heavily, it's just simple average, but I do find exponential to be better. Then you choose the length, I don't have any offset, you choose the color, and then you press OK. The VWAP is an interesting indicator. This is like a moving average, except that it also factors in the price of it also factors in the amount of volume that occurred at each price. Okay, so what you end up having is a moving average that's also weighted really based on volume. So it's a much better reflection of the average price of the stock over the period of the day. So if you want to think about the average price, well, investors, they're going to want to get into a stock as close to the average price on the day as possible. So they wouldn't want to buy a stock really extended off the moving average. They'd rather the volume weighted moving average. They want to buy close to that VWAP because that's like the best price basically of the day. It's the average price. When you're buying really high, you're extended. When you're buying really low, you're extended. So this is also helpful because something that we notice is that when stocks make big moves like this, they often return back down to the average price, right down here. So the VWAP is a good target when we're doing reversal trading. The reversal back to the average price, back to equilibrium, and then, from there we can coil and move back up or be sideways or whatever it is. So there's a lot of traders that use the VWAP actively in their strategies. I don't use it that much because I don't do a lot of reversal trading. And for momentum trading, it's not usually that helpful because the price is almost always pretty far away from the VWAP. So it's just always way back down here. Now, during a pullback like this, it could be helpful, but that's kind of the only scenario if you're doing momentum and you're doing this pullback. But this is a 5-minute chart, and this is a pretty steep pullback here. So I would almost be more inclined. Now, keep in mind that during this pullback, it's actually a different chart. So during this pullback here, these moving averages, the 9, the 20, the 200, let's see, where would they be? We've got the 9 right here, and we've got the 20 right here. So I would be using these moving average, seeing, oh, it's broken below the 9, that's not good. It's at the 20. If it's consolidating at the 20, and now the 9 and the 20 are kind of pinned together, I would see that in a similar way here, where you're kind of finding support off your moving average. Happens to also be the VWAP, so either way, I'm not sure if it would really help me to have this on for momentum trading. So the VWAP has no settings, it just is the volume weighted average price. It's the same on all time frames. Of course, a moving average is different on different time frames because 9 periods on the 1-minute chart is going to be a different average price than 9 periods on the daily chart or the 5-minute chart. But I use the same moving averages. On the 1-minute chart, I take off everything but the 20 moving average because the 1-minute chart is very crowded and all I really want to see is the candle and that 20 moving average. The 9 is too close to the price and the 200 is too far away usually to be relevant. Bollinger Bands. All right, so a Bollinger Band is 2 moving averages that are offset. So they have an offset. And now during this offset, almost all of the price action, 90% of the price action, will occur inside the bands. So the price might bounce from the top band to the bottom band, but it's almost all going to occur inside the Bollinger Bands. That means if the price is ever outside of the Bollinger Bands, it's extreme. And we trade extremes. So outside the Bollinger Band, that's the time to short the stock, right? So it can come back down inside the Bollinger Bands. Up here, this is a time to short the stock to come back in. So I use this only for reversals, for helping me time that entry. I want to see the candle outside the Bollinger Band. Now, in this type of scenario here, I wouldn't be interested in it because we're grinding higher. We're riding that top band, but we're not actually getting through it. But up here we do, and then of course up here we do. And that's where we start to see some really good reversals. Now, of course, I have other criteria for a good reversal, including, 5 to 6 consecutive green candles, which we had here, and we had here, but we did not have right here. This was only 4 candles. This would have been, only a so-so reversal. Note that, we often have pretty high volume on that final candle that goes up through the bands. So here you can see you can have the middle band. I always have that turned off, and then you've got the upper and the lower band. I use a length of 20, so it's a 20 moving average with a standard deviation of 2. And you can tell that once you start getting all of these indicators on your chart, it's going to start to look pretty crazy. And I assure you, I've seen some very busy charts that people have shown me. And we'll step back and look at a couple of charts with a lot of indicators in a second. Tim, I'm talking about 5 green candles on the 5-minute chart. And we'll go over that in the reversal strategy. Right now we're just talking about the indicators, but when we talk about the actual reversal strategy, we'll talk about those entry requirements and that sort of thing. The relative strength index, this is one of those oscillating indicators. It goes up between 100 and down between 0 and 100. Above 80 is considered overbought. Below 20 is considered oversold. So an RSI, relative strength, if it's above 80, the stock is very, very strong, but it can only remain that way for so long. So it's an exit. It's a possible exit indicator. It's also a possible reversal indicator. An RSI below 20 is considered very weak. So a possible reversal indicator there off the bottom. Some of the scanners I use, even though I don't have RSI on my chart, I'll look for stocks that have a very, very low RSI, like an RSI of like a 5 or a 95, really high, really low, because they're so extreme that we're bound to get a good reversal at some point. And it doesn't always happen, but there's a really good likelihood when we get that extreme. And that's also like looking for 10 consecutive green candles. How many green candles can we have in a row before we finally get that red candle? All right, so looking for those extreme situations, scanning for them, and that's what I do. You can see right over here, these scanners in consecutive candles. We've got 8 consecutive candles going up, 9 consecutive candles going down. That's something I'm interested in seeing. Over here, this scanner is only looking for consecutive candles. 13 consecutive red candles on CVE. We'd just take a peek at that. Now, it could have been one that's just grinding lower, but let's see how it looks. There you go. You've got 13 consecutive green candles, and then look at that reversal. Now, this is a $15 stock, so we only went from 15.09 up to about 15.20. So the range wasn't that big, but this pattern you will see on stocks of all price ranges. You might see it on a $150 stock and you got, a really big bounce. You might see it on a $50 stock and you also get a big bounce. But this is the right type of pattern to look for. And then back here we also have our high-low RSI. RSI above 90, RSI below 10. Giving us those extremes. That's what I'm looking for in the market, are extremes, because those are opportunities to take trades. So the RSI, you can draw, I have a line drawn here at 80 and another one at 20, and you can see those right here. The green line at 80, the red line at 20, and then I just highlighted when the price action was outside that line. You can change these settings. TC2000 has a lot of really cool features where you can change these and you can adjust the opacity. So you could have certain indicators really bright in the foreground and others a little bit like lighter in the background. And you can create some really beautiful charts. All right, now this is the area where we will combine technicals and fundamentals. This is the only time we'll combine them. It's in the morning when we're preparing our watch list. What we want is confirmation that there is some catalyst. We want a reason that the stock is going up. Now, it's true that we sometimes have technical breakouts that have no catalyst at all, and they're still great. So we don't necessarily need a catalyst. Sometimes there'll be a catalyst that's like, the company's presenting at a conference and the stock goes up 100%. And you're thinking they're presenting at a conference, they didn't cure cancer. Look what's going on. But the market reacts how it reacts. So we follow the market, we trade the chart, and we let the fundamentals sort themselves out later. But it is important when you're making your watch list that you do take note of what the fundamentals may be. It's not, you might start to get a sense of some fundamental catalysts that are stronger and some that are weaker, but they also vary from time to time and from stock to stock. So it's not something we can always count on, but at the very least, you want to make sure you take a look at the fundamentals. Whenever I see a stock spiking up, I'll say, is there news on this? Is there something driving this move? And that's important because if there is something driving the move, I'm going to be a little cautious about going against the move, like shorting the stock. But if I find out that a stock has just gone up 200% and there's no news, I'm going to think, okay, well, this has a higher likelihood of fading because there's no fundamental catalyst. But when the fundamental catalyst is they came out with a cure for cancer, then you don't usually try to short that stock when it's going up. It just helps you kind of develop a little bit more of a bias. But again, you let the price action give you the confirmation. And to answer your question there, I don't add the RSI to the chart. So I don't even care. I just look at it on those scanners, and if it says the RSI is 5, I know it's at the bottom. If it says it's 95, I know it's at the top. It doesn't really matter what it looks like. I just want to know. It just helps me understand the context that this is a stock that's very, very extended. So part of our daily routine is, getting up in the morning, scanning the market, looking for those stocks that are gapping up, looking for the catalyst. And it's also important to start looking at the daily chart. There are some traders that believe you have to have a strong daily chart in order to trade a stock. And then if you don't have a strong daily chart, there's no trade. And I used to believe that, but then I found so many times that strong intraday stocks with really good news override bad daily charts. They do it again and again and again. And eventually I said, look, the catalyst is more important than the daily chart. It's not to say a daily chart's not important. It is. And the perfect combination is a great catalyst and a great daily chart. But don't write off a good catalyst just because the daily chart isn't perfect. Now, there's also a difference between perfect daily charts and just outright bad daily charts. And this is where we can start to combine things like, well, today's a day where we have 5 gappers, and 2 of them have great daily charts, and 3 of them have bad daily charts. And, of the 3 that have bad daily charts, 1 of them has one of these headlines that sounds like a joke. But the other 2 are still kind of interesting, and sounds like good news, so maybe I'll keep those on watch. And you can kind of talk your way through it and, get rid of the ones that just most likely aren't going to go. You can keep them on watch if you have the space, but generally it's not worth it. So then, of course, what makes a strong daily chart? The first thing I look for are windows, and I mark them out with trend lines. So that might sound a little foreign. I also look for ascending and descending support and resistance trend lines, and I mark those as well. I also want to mark out all the potential triggers. And when I'm looking for triggers, as I'm looking at a stock chart, I'm looking up and to the left for triggers. That's when I'm looking at stocks going up. When I'm looking at stocks that are going down, I'm looking down and to the left for my triggers. I'll show you how I do that in 1 second. Now, there are two other types of charts that can be strong, but may not be very obvious. One is a stock that's hitting 52-week highs with no recent resistance. In this case, we're not going to be able to map out any obvious support or resistance areas, because the stock is at 52-week highs. So what we want to do is we want to look at the catalyst that's driving the move and see if we think it's strong enough for continuation. And then the second one is a stock that's coming out of oversold. So it's been bottomed out for a really long time, and now it's starting to come back up. The important thing to look at, though, is are we above our moving averages? And where are we in relation to the 200-day exponential moving average? If we're below it, we're going to expect some resistance as we come up to it. If we're above it, then we should be in good shape. And one last thing to note are whole dollars and half dollars. These are very important price levels on stocks, especially under $10, but really on stocks of all price ranges. We almost always have a little bit of resistance and a possible trigger when we're approaching half dollars and whole dollars. And you'll see that I take a lot of my entries, right around those levels with a stop just on the other side. So a stock at $3.99 will see a lot of resistance at the $4 level. Once it breaks that level, anyone that was short, they put their stop right there. They put it at $4.01. So when we break over this critical level, we'll see their stops fire off, market order, and that instantly pops the stock up to $4.10, $4.20. So we can get in these at $3.99 and sell at $4.10 and $4.20 so consistently just by taking advantage of the that kind of market behavior, the fact that people do that. And we can do it also with half dollars. Now, we wouldn't do it with stocks that aren't in play and aren't the right type of stocks to trade, right? So we wouldn't be doing this with Facebook and Apple, but we'd be doing this with the stocks that are kind of in our wheelhouse for being good account builder stocks that have a catalyst that are moving quickly. So any stock basically that's probably going to be on our watch list. All right, so this is something that we'll talk about more as we look at setups. Later in the course, I'll show you lots of examples of getting in at a half dollar. That example yesterday of GBR, I was in anticipation of the half dollar break. I think it was 239 or 139, and then we had the move up towards 2, a little resistance at 2, and then 250, a little resistance at 250, and then up to the 280s. Very common to see that. All right, so now let's go back to what I was saying about windows. So what was I talking about? When you look at a daily chart, like this one right here, what I look at is I look to the left and I look up. So we see here, for instance, this is automatically drawing these lines. This is an e-signal indicator called Warrior Windows, and you can download it. I'll show you how. But right now, what we have here is a trigger right here at 9:10, which is the top of this candle over here, and there's nothing in its way until the top of this red candle. So from 9:10 to 1365 is a large window on this chart that's taking the form of one huge candle. All right. Then you have another little window right over here, which looks like it's, not sure what that is, the bottom of a candle wick, I think, the bottom of a candle wick, 1461, that goes all the way up to 2175. So two really big windows here. Now this space in here is, it's a small window. There's a little something there, but not a lot. Above this level, there's nothing. So when we look at the daily chart, I would say this 910 spot is a pretty important level. If we can get over that level, say we're gapping up to like 880, I think, man, if we're over $9.10, we've got no resistance until 1365. It doesn't mean we're going to go all the way there, but it sure helps that there's no resistance until that point. Okay, so now when we first look at this chart and we go to the left and up, so we're looking left and up and left and up, left and up. We see little lines, little areas of resistance, but not a lot. So the green line is the trigger, And then the red line is potentially resistance because there's not a trigger on the other side. It's not a trigger. So triggers are green, and then the top of the window is red. Okay. Let's see. So, and to answer your question there about the whole dollars and the half dollars, you wouldn't assume that every stock breaking 399 is going to instantly hit 415. And even with a catalyst, not every stock is going to do that. We do have to take into account the pattern. Is this an extension already going into the whole dollar, or is this part of a pullback? But the whole dollar is an important level. So when we combine a pattern like a bull flag that's occurring right near a whole dollar, that strengthens the pattern. And sometimes stocks are strong enough that we can get in just at half dollars and whole dollars and scalp those levels as we move up. So I'm not, in terms of how to label these, I'm labeling the green line here as a trigger because above it is lots of room. And then the red line is resistance because above it is not necessarily a lot of room. So green trigger, red resistance. Now, like any indicator, this is, basing some conclusions or drawing some conclusions on the instructions that we've given it. So it doesn't mean it's always going to be exactly accurate. Here's another stock, LXU, and you can see here these windows stacked up. So this is a green trigger, 1176, that has no resistance until 1366, so that's a trigger. And then above 1366, there's no resistance until 1583. So we've got two triggers in a row. Now this first one is the top of a candle. From the high of this candle, we go to the left and we go up, and we've got nothing until the high of this candle. And then we go left and up, and we've got nothing until the bottom of this candle. Now, left and up gives us another line like right here. Okay, so we're only looking for big windows. These are going to be almost meaningless on the 1 minute or 5 minute chart. These are how we break down daily charts specifically, and I'll show you why in a minute. All right, so this chart has lots of little windows. You can see, these are fairly big windows even, 27 to 30. These are 3-point windows. So a window is a large area with no support or resistance. It can be either formed by a gap or a large candlestick. Okay, so in this case right here, this was a gap, but this was a candlestick. And this is a candlestick, but then of course this is a gap. And it doesn't matter which is which, because either way we have no resistance until the top of this candle here or the bottom of this candle here. The best setups have several windows lined up. And a good window has the average true range of a stock inside the open area. Okay, now this is pretty important. The average true range of the stock. That's the average price range on a single day. So some stocks, their average price range might only be 10 or 15 cents a day, whereas other stocks have an average price range of $5 or more a day. So let's take a peek at that. I'm going to go and full screen this chart here. All right, so we're in eSignal. I'm just going to double click this and click add average. Let's see, it's going to be called ATR. Sometimes it's average true range, sometimes it's ATR. Oh, let's see. There it is. Okay, so I'm going to close this and I'm just going to overlay it right there. All right, so the average true range. So let's look at a stock like, let's look at Sprint. Okay, the average true range is 14 cents per day. On an average day, this moves only 14 cents. And if you want to look at the 1 minute chart just to see what that looks like, it looks like this. This stock doesn't move, hardly at all. It hardly moves at all day long. That was the entire range. And yet, it still managed to trade millions of shares of volume. But it doesn't move. Bank of America. This is another stock with a very small range. So it doesn't move, right? This average range is 35 cents. But then let's take a look at Tesla. Obviously, Tesla is a more expensive stock. It moves 7 points on an average day. The ATR is going to go back, some will go back 13 days, some will go back 14, 30 days. It depends. This looks like it's predefined at 14, and that's fine. That's not a problem. And this isn't an exact science where it would make a huge difference, because what we're generally looking for are, these potential windows and that sort of thing. VLTC, this is one of the cheaper stocks. This has an average range of about 30 cents a day. Not bad. Has some big days. So that means anytime you have a gap or a candle that offers you more than 30 cents of range, you have the potential for a window. So you can see this window here, the green, is from the bottom of that candle, or the top of this candle up to the top of this one. It looks like there's a small one right in there. Okay, so what we're looking for is the average range a stock trades in a day, that would be the minimum size of a window. It's basically to say that a window should be, at least the size of an average candlestick going up or down. If there's some stocks you want me to look at the average range on, just shout them out in the room and I'll take a peek. I'll look at those again in a second. Okay, so generally I like stocks with a higher ATR because those are stocks that move faster, right? Stocks that move slowly are not as interesting to trade. That's why we don't trade Bank of America or Sprint. We like the faster moving stocks. So when I'm looking at these daily levels, I'm looking up and to the left, and I'll show you, we'll do this in real time. Give me a couple charts or stocks, and we'll go mark out those charts together. So a trigger is a price right where the window begins, all right? And then resistance is the top of the window. Now, sometimes windows are stacked together where it's a trigger and a trigger and a trigger, but this is a price to the penny where you think a breakout could occur, potentially, because above this level, there's nothing. And these triggers should be very obvious enough that every retail trader should be able to look at that daily chart and say, yeah, this stock has a really good daily chart with some real potential. You don't want to overcomplicate it. I know it sounds a little confusing the way it's a little hard to explain, and I'll show you with examples to make it more clear. But it's pretty simple once you get it. All right, so what's a trigger versus resistance? Well, resistance is usually kind of it's the top. There's not a lot of potential past a resistance level. Whereas a trigger still has lots of resistance, still has lots of potential on the other side. Okay, so triggers open up windows and resistance close windows. And of course, the bigger the window, the more potential that you have. All right, so the Warrior Windows indicator right here, you can see this is featured on eSignal. So we'll go step back here. We'll step back in 1 second. There's some settings that you can adjust, and I'll explain where we get those from. So to break down the daily chart, the green lines are the triggers, and the trigger must have the ATR distance to the next high or low. ATR in the case of 75 cents in this example. The space between the high and low must be at least the ATR distance, and that makes it a window. Top of the window is a red resistance line unless above the high of that red line is another 75 cents, in which case it would be green because it's another trigger. So this right here is a trigger. The high there, when I would look at this chart as it's coming up, as Pandora's moving up, we've got a high of 1556, the high of this candle. And as we look left and up, there's nothing until this one right here. Remember that a gap like this, we look to the next candle going up. We wouldn't skip it and go into here. We look right to this candle, the previous candle. And gap fill is something that happens when an entire gap is filled by price action. And we actually see this a lot, to the penny. You can see on this example of AQXP, gap fill to the penny. From 381, that was the bottom of the gap, all the way up to 655. There's your gap fill. So as soon as we broke 381, what was our next resistance level? We had no resistance until 655. So when you're looking at a chart, you can see the gaps pretty easily. They're pretty easy to identify. You know, those big gaps with lots of space. All right, now when you're actually getting into mapping out all of the support and resistance levels, it can get a little more complicated, but the obvious gaps are usually pretty easy to notice. You've got TripAdvisor here. Now, on this stock, we had this was gapping up, so it was a gapper. So it's gapping up, and now we look at the chart, and we see this resistance line right here, the high of this level, and that right there opened us up to a window of no resistance up to the bottom of this candle. And what happened that day is we opened and we squeezed all the way up. Now, I thought we would see resistance there because not only did we have the gap fill, we also had the 200 moving day average, the 200-day moving average. But we were actually able to get through it, showing that a strong stock can break through some kind of, bad quality setups or bad quality, daily issues like resistance. Okay, here's an example where the long candle forms the window from 372 to 396. Now this is valid because this is a lower price stock with a smaller range. So that's still an area to take note of. So as soon as we get above 372, the next target is 396, and that's right up to the whole dollar. Gap fill. Another gap on the daily chart from 845 up to 1065 right here, breaking through the 200-day moving average. All right, so now let's take a look at a couple charts. So someone mentioned cores. All right, now I'm gonna delete these trend lines. All right, so those are gone. Okay, so what you can do to insert a study, you press this little plus button, insert the study, and then you go to add-on studies, and you start typing in Day Trade Warrior, and you can see Warrior Windows right here, and then you can apply that study. All right, now when you're looking at that study, this gives you some information. So the ATR period, do you want to use 14 days or 30 days? And then the multiple. How big does the window have to be? Does it have to be the ATR times 1, or do you want bigger windows, 2 times the ATR? On a stock like Bank of America that has a very small range, you might want a bigger ATR multiplier just to make sure the window is a little larger. And then you can make some decisions about the thickness of the line and whether to process long or process short, and then also whether to draw the prices right up here on the side. Okay, so we've got cores here. So if you look at cores, what do we see? All right, let's look at the chart. So we've got the high right here. That's a high of 50.97. All right, so let's look to the left and up. And now the ATR of this is $1.63. So we're going to look for windows. So we look to the left right here, 51.38, and up to here. And that is like just below. It's $1.30. It's like $1.30. So it's just under the ATR, but it's not bad. There is potential there. Okay, so this is me just drawing trend lines manually, and then of course we have the automatic ones in the back that are green and red. All right, so what's above 52.66? Let's go to the left and up. It's 53.05. Okay, what's above 53.05? Go to the left and up, 55.23. Okay, that means from 53.05 to 55.23 is a window. So that's why we've got the green line there, and I'll just go ahead and draw it again. And then what's above 55.23? Oh, it's this little high of 55.37. Okay, so 55.23 is resistance. It doesn't have a trigger. And then we go left and up. This is a high of 54.20. That's nothing. That's nothing. All right, and then we go left and up. Still not big enough. The high is 56.71. Then we go left. 56.71. We had a high, almost the same high both days, 60 and then 71. And then we go left and up, and we're at 58.63. Okay, so now we have a window right here. We've got a window from here up to here. Right? And then, okay, what's from 58.63? Let's go left and up. And that's 59.49, which again is darn close to being another window. It's just a little bit too small. But it's close enough that you could go ahead and draw that. So then now you have these lines on your chart. So we could either turn off all the horizontal lines, or I could turn off my windows indicator. If you were manually drawing them, this is how you would draw them. You know, going left and up. So as the stock starts moving up intraday, you know, say we switch back to a 5-minute chart, you know, we'd be looking at this and thinking, okay, well, these are some of the areas we're going to run into. Potentially, as the stock moves up, these are our potential resistance areas, potential triggers. So now you don't really have to look at the daily chart because you've mapped them out here. And you know these are areas that are going to be important, potentially. All right, now this is obviously based on having a gap with, you know, that catalyst of some type. So let's see, FROS, invalid symbol. Okay, I'm not sure which one that was. STAF. Okay, this is one from today. Oops. STAF. Okay, so this is one of those ones today that was obviously a big mover. Look at how it tapped the 200-day moving average almost to the penny. Right? That's not a coincidence. If you didn't have this on your chart, would you have been the guy buying here at 55 or 50 thinking this is breaking the half dollar? Right? You might have. That's why it's important to have that there. That gives you that, okay, that's just peace of mind. There's going to be some resistance here. All right, so the average true range of this stock, let's see, it's, well, it's been only like 25 cents. So the windows are going to be fairly small. So basically, I would look this to the left and up. So this is all kind of choppy stuff in here, but we do have a trigger, I would say, from here to here. But you have the issue that this is a trigger, but it's also the 200 moving average. So the 200 moving average creates a problem. And then above that, you know, it just kind of gets sloppy. This isn't a very good chart necessarily because the chart itself doesn't give you a lot to go on, and there's not as much we can base it on. A lot of these small caps end up being, you know, more responsive to that strong catalyst than the chart, especially one that's coming out of kind of no man's land. But CLRB, we can look at that one. This one made a pretty big move today. And you can see it's had a couple moves in the last few days, so in the last week. So we've got this big push up, a little bit of a pullback, up, pullback, up. Now on this one, I might draw a trend line from here to here because you kind of see this flag forming, right? Now, a trend line is only valid really when it touches it. Well, obviously it has to touch at least 2 places, but if it touches in 3 places or 4 places, it becomes a little bit more valid. And this one here touched once, touched 2, and then it came up and kind of tapped it again today. So that's sort of helping me see there's a little bit of a pattern forming here. On the daily chart, this is one of those ones, again, where you don't have a lot of big windows. You have one from here to here, obviously, that takes the form of that candle. You know, but then all of this stuff is pretty small. At the same time, this stuff is, you know, starting to get far back enough where if we have a strong catalyst, I wouldn't necessarily consider any of this resistance. but I would consider this to be a trigger. This is still a good trigger right here, and that's the top of the window, and then you've got the moving average coming down here. All right. So these are daily support and resistance levels based on the pockets in the windows, just to answer your question. So if you're talking about, like, would I use support and resistance in the sense of, what's a good chart? Or say just in this area, would I use this line here as support, as a support level? If I was thinking, oh, is this a short right in here? It's kind of like this. Yeah, I mean, I would look at that. And I would also look to the bottom and left to say, is there anything in the way of support? And there's not. So not only is this a bit of a support level, it's also a trigger that if that level breaks, we've got a lot of downside potential. But it is a little bit different because when you're kind of looking at resistance like this, you might draw it based on what looks right and not necessarily to the exact penny, even though that penny would probably be the right trigger. So let's see, what's another one we could look at? We could look at eyes. This one was gapping up a little bit today. This is another one of those stocks that's been fairly weak. It's starting to get above its moving averages today, right here, the 50, which is good. But we don't necessarily, the first thing I would notice as being an issue is the fact that we'll have the 200. That's the most obvious thing we're going to run into. It's kind of sells off and then pops up, sells off, pops up. I'm not sure that this is any clear, very well-defined resistance. It's definitely not like that flat bottom we were just looking at a second ago, or even the ascending, or it's not like the flag that we saw on CLRB. It's just sort of slight, slight resistance as you get up into those levels. Same sort of thing here. So we can look at another one, JAGX. This one we traded today, and I looked at it, and of course what I thought was, okay, well, we've got the 200 right here, and then once we get above that level, what are our triggers? So we go left and up. We've got a trigger at 276, and then we've got another one at 310, and then this is resistance right there, but above that level we have room up to 52, and then above 52 we've got room up to here. So those are kind of the windows that I'm looking at. And then of course I can just turn on my Windows indicator, and that's going to draw the windows in the exact same places. So now let me go clear these out. Whoops, I have to turn it back on. Okay, so that turned it back on. Well, actually what happened is now today's high has just broken that window a little bit. So that window's broken, and of course this window doesn't exist anymore since we just blew through that today. But if we were looking earlier, it's more like what it would have looked like. But we also had, what else did we have for gappers today? Just take a look. Try to remember some of these. We had ACUR, so look at the daily chart of this one. The daily chart's the first thing I look at when I'm looking at a gapper. What's the chart look like? Are we coming up into resistance? Is it a clean chart? Looks like my charts are having a little bit of trouble loading here. Just had a pen now. Can't seem to find where I put it. All right, so ZHNE, I knew this was coming up and it was going to hit the 200 moving average pretty early on, and I was concerned that that was going to be a problem. But obviously it didn't end up opening up that much. So seeing that you have that issue there, and then the highs of the candles near it Just not any big triggers, nothing really exciting to look at. All right, can you guys see the screen now? Can you hear me? All right, I think I lost my internet connection there for 1 second. I'm not sure, but in any case, I have the recording going, so you guys will be able to watch the recording. And there shouldn't be any breakup or lag on that recording. All right, so ZHNE, not the cleanest daily chart as we come up to the 200 moving average. No pockets or big triggers. The triggers are further up, so just not a lot on that chart. ACUR, this was another one that was gapping up. This one just gapped up and sold off. But again, it didn't have a lot of big windows. The good thing about this, though, is that it was gapping above its moving average. So we didn't have to worry about it being below the moving average. So that was good on ACUR. Let's see. GBSN, this is one of those stocks that's just been really beaten up. So its daily chart is absolutely horrible, and you're not going to see a lot of good triggers on it. When we zoom in on this chart, you can see how much it's dropped. So just pretty sloppy stuff. You can see it looks like there's a small trigger around 269 that opens it up to 325. So from the top of that candle going left up to 269 to 345, and then we've got one here, the high of this red candle, 446 up to 607. So those are possible triggers as you come up towards this moving average. But of course, this stock has been so weak that it's a tough one to want to trade. So whenever I'm looking at the charts in the morning, I'm looking at the position of the moving average. So when I saw this FNJN gapping up, I looked at it and I thought, this is good. It's above its moving averages. We're above the 200, above the 9, the 20, the 50, all of that. And then I look for triggers. Do we have any triggers? We don't have a lot, but we also don't have any clear, strong levels of resistance. All right, just to answer your question there, Simon, you can see that in the room. Cali, another one, this made this really big move. We now have a trigger here at 229 that goes all the way up to 440. This is a brand new window that just formed. So right in here. And as we were gapping up that day, I looked to the left and I saw, okay, we've got this high here of 250. And then what do we have above that level? Nothing for a long time. So lots of room on the daily chart. So that's what we're looking for. What's the daily chart look like? Is it open? Is it clean? Or are we gapping up into moving averages? So I want to see a good example of gapping up into a moving average. Here's a good one on ORPN today. So this was a gapper, but we're gapping up into this 50 moving average right here, and that's a problem. We don't have any triggers there. There's not necessarily a ton of resistance of candlesticks, but you have the issue of the moving averages, and that's going to hold it down a bit. Okay, so in addition to being able to draw your stationary and flat support and resistance lines, it's also important to know how to draw trend lines. So those can be angled trend lines, like the flags that I was drawing on CLRB. This again is, these lines are only valid if the price touches at least 2 times. And if it only touches twice, it's not very valid. We want to see it tap multiple times. So you can see here on BIOC how we've kind of got this channel that the price is working inside of. It's especially strong on the bottom trend line, but it's broken a couple times on the top. This chart here on GoPro, this is another really good one where you've got that descending channel. So the descending resistance line at the top and the descending support line at the bottom with multiple taps. So each of these taps helps it gain some validity. So if we were looking at this stock as being a gapper, I would say, well, okay, we've got a couple issues. One, we're going to have moving average resistance. We've got this red line. Two, if we're gapping up but we're still below this yellow trend line, we're going to have trend line resistance from this descending line. And then, of course, we can also draw out our windows. Do we have some pockets or windows or any big triggers? And in this case, it looks like there might be something in here, but not a lot. In general, though, I don't spend a lot of time looking at night at daily charts or doing that kind of thing. I focus just on researching in the morning, putting together my watch list. How does the chart look on this stock today that's gapping up? Because without the gap, the stock's not usually going to be in play. So if you just look for daily chart patterns, you're not necessarily going to find anything that's going to work, because what makes the pattern resolve is a catalyst. It's volume. So although you can have some technical breakouts that resolve purely based on the technicals, generally the best patterns are going to break out with a catalyst. So instead of searching for the best charts, we look for the best stocks, the ones that have that strong news catalyst, a fundamental type of catalyst of some type. And this is something that we talked about a little bit yesterday as well. Should we scan for perfect patterns like the perfect bull flag or the perfect flat top breakout? Or should we look for the best stock and then apply whichever pattern that stock gives us as the one that we want to trade, because we know that's the stock in play? Do you look for the perfect? Do you look for the semi-perfect, so-so bull flag on the right stock, or the perfect bull flag on the wrong stock? You need to be trading the right stock first, and then you just analyze the chart and take what it'll give you. So tomorrow, we're going to start looking at these intraday chart patterns, including flat tops, flat bottoms, bull flags, and bear flags. And again, this is another extension of understanding and minimizing our risk. Right? We understand the foundation and the fundamental concepts of risk management, and then we minimize that risk by trading only the strongest stocks. And then we further minimize that risk by avoiding entries around the 200-day moving average, by understanding resistance on the daily chart, by understanding triggers and ascending and descending support and resistance lines. And now we're going to reduce our risk even further by only trading the best candlestick patterns. So those formations that we know are so well respected by retail traders. Okay, so your homework tonight is to identify 3 charts with excellent triggers and windows on the daily chart. So each window or trigger should have at least the full ATR of that stock. So whether you want to look at stocks, the best way to do this really would be tomorrow. Look at the gappers tomorrow as you build your watch list, and make sure you map out those triggers. And feel free to email those to me so I can take a look. Ross@warriortrading.com. All right, so we can do some question answer here. Anyone that's in the chat room that's still here, you guys can post your questions in the room, and anyone that's watching on the video, feel free to email me questions. All right, so I'll read these, go through these here in 1 second. Let's see. I want to reset my screen share for you guys that are in the room. All right. So go ahead and type in any questions that you guys have, and I'll answer those now. Let's get the screen share back up for you. No, I had a pen. I don't know what I did with it. It's gone. So, is relative volume the same as average volume? Well, when we look at the relative volume, that's a calculation. So relative volume might be 1 today, right? Because the stock is trading on just its total average volume. It's absolute average. So you've got a relative volume of 1, whereas the average volume might be 200,000 shares a day. So those are two different numbers. Average volume would simply be the average shares traded. And that's usually not going to be that significant for us, just because, you know, as long as the stock has a good catalyst today, you know, we're going to be interested in trading it, even if it doesn't have, you know, a very high level of average volume. So if you are having a hard time getting the eSignal Warrior Windows to work, make sure you go and update. So you got to go down here to About, check to see which version you have, and if you don't have the latest version, you know, if you go to add it and it's not there, then you need to update to the latest version. RSI, you know, let's see. I'm not 100% sure how RSI is calculated. Let's see. I don't know if I put it on here, if it'll give us any description. Oops. RSI. There it is. Close. Yeah, you know, I'm not sure exactly how it's calculated. You know, it's something you could look up. It's obviously something to do with the price and, you know, over the last X number of periods, and then it gives you the oscillation. So you're either in the overbought area or you're in the oversold area. You know, and so what I was saying before, your charts can get as complicated as you want, and I've seen students with lots of stuff on their charts, and the problem is it kind of gives you this like analysis paralysis where you've got too much stuff going on and now you can't focus because you're getting so many alerts, right? Oh, well, the MACD is above, you know, the signal line, but the RSI is down here, so this is a buy. But that could be a complete false alert because you have too many indicators telling you different things, and they can actually give you a false sense of confidence because you see these all lining up, but it doesn't necessarily mean it's an entry or an exit or a reversal or whatever. You know, it just doesn't always mean that. So that's why you can see my charts have always been simple. I just keep it as simple as possible. My intraday charts are just moving averages. And, I make good money trading, so I'm an example of the fact that you don't need all this extra stuff. When I had it on my chart, I think it distracted me more than anything else. So this indicator, the Warrior Windows, is obviously customized for eSignal, and it's written in the eSignal language, which is a little different from TC2000. So I don't think that there's a way necessarily to make this same indicator work, but you could rewrite it in TC2000 if you know how to do the codes there. Essentially what we're looking for, obviously, are pockets with a full ATR or more. But you can also just manually draw them out. And that's really good practice as a new trader, to manually draw all these support and resistance lines. All right, so let's see. So sure, to clarify on relative volume, and I'll just bring this up into the screen so you guys can see. So relative volume, if a stock trades 100,000 shares a day on average, then its relative volume, if it's trading 100,000 shares, if it's trading its exact average, it has a relative volume of 1. So whatever the average volume is equals a relative volume of 1. Doesn't matter if it's 100,000 shares that's average or 10 million shares that's average. Whatever is average equals a relative volume of 1. So when you're trading on twice the average volume, you're going to have a relative volume of 2. Again, if your average volume is 100,000 shares, that means when you trade 200,000 shares, your relative volume is 2. If you trade 10 million shares on average and you trade 20 million shares, your relative volume is 2. So relative volume is just the multiple of the average volume that's occurring today. So are we average, are we below average, above average, and it's just calculated using relative volume. So for eSignal, I'm using the middle of the road package. They have one that's a little less expensive and one that's a little more. They have 3 packages right now. And the one I use is about, I want to say $130 a month, plus $30, I think, in exchange fees. So it ends up being about $172 a month. Any other questions on how to draw these windows or anything else? Well, I don't know which ones they're going to make you enroll in. I'm not sure if they require... they may require everyone to pay those exchange fees because level 2 is just included, even if you choose not to use it. The thing is, some people use eSignal to trade with. You can connect this to various brokers. It's not something I would do personally because, well, I like the Dash Trader platform that I'm using right now on SpeedTrader, and I wouldn't really want to use a third-party program because of my concern of latency, and sometimes eSignal does lag just a little bit. So I wouldn't do that, but because you can, and because level 2 I think is standard, they'll charge you that exchange fee for that. Sure, let's look at Restoration Hardware. Yeah, we can look at the daily chart on this one. Okay, so here we've got a big gap down. So as of today, we now have a big window right here, right? If we were going to go look, to the long side, we know we have a window all the way up to 34.88. And then we have another small window from 34.88 to 36.65. And then nothing really here, a moving average, nothing big here, and then a little trigger from 44.47 up to 46.40. So, you've got, it's obviously a pretty beaten up stock. If you were watching this for a short, well, either way, I mean, if you're watching it for a bottom bounce today for a long, you had potential all the way back up to 34.88. So good potential, although you'd probably hit a little bit of a resistance area around these moving averages. And you can see as you stretch out this chart, it does start to give you some pockets here and there because, Restoration Hardware does have some big days from time to time. I couldn't find it either, and so I updated my eSignal, and it gave me the newest version. So it might be like 12.4.4. I mean, well, I'll tell you which one I have right now. I've got 12.4.4150.965. So that's the one. As long as you have that, you should be in good shape. All right, so as you start to look at the daily charts, as you're looking at the gappers in the morning, pull up the daily chart, look at the context. This is the bigger picture. These moving averages, these are going to help you understand, are we bullish, are we bearish? Are we going to run into a resistance level as soon as we start to gap up? That's what I'm looking for. I'm looking for that chart that has nice potential. Anytime I see a gapper like the one we were looking at on ORPN, where we're gapping up right into a moving average, which one is it? Yeah. This always makes me a little cautious because unless the catalyst is super, super strong, we're going to have an issue. This issue here is at the 50 moving average. We've already tapped it once, twice, and then today we couldn't get even a tap against it. Right? But then on the other hand, JAGX, I knew this had the 200 moving average and that there was a possibility that would be a problem. But the best time of day to break through resistance levels is in the morning. So this one right in the morning broke through it and it was no problem. Strong catalyst, strong momentum, low float, overrode what might be kind of like not an ideal daily chart. And this isn't an especially great daily chart. There's nothing super exciting going on there. DGLY, these gaps, these windows, these are going to be here forever until the price fills it. So some of these way up here might stay open for a long time before the price starts to come back up and fill that level. So they're always going to be there. Now, we've had a couple days where this popped up, back down. In this case, when we have this sort of scenario where we're breaking above moving averages, like this is breaking above the 9 and above the 20. Now we've got room up to the 50. This area in here, I don't see really as being a lot of resistance. I mean, you don't have big triggers, you don't have a lot of resistance, so this shouldn't be an issue. No, unfortunately I wasn't. I wasn't really planning on doing a pre-market trade, so I didn't have my recorder going yet. I usually start at like around 9:30. So that one wasn't recorded, but we do have a bunch of recordings that we'll be able to share later in the class. And yeah, you can definitely send me charts, map out the areas that you think are support and resistance. I can take a look. We don't need to overcomplicate it, and you don't necessarily need all of these lines. But if you just map out the ones that are nearby and are going to be relevant today, that's definitely going to be enough. Like I said, I've seen a lot of people get their charts very complicated, lots of lines, so much so that you lose track. So any resistance point that you're looking at should be obvious. It should be a place that everyone's going to look at that chart and say, yep, this is where I want to get in, this is where I want to get out. If it's not obvious, then people aren't going to be seeing it, and it's not going to be very well respected. Right? So that's the same thing we're doing with stock charts, you know, the bull flags, the flat top breakouts, those patterns. We're looking for the obvious setup because those are the ones that all the traders are going to jump into, knowing that that's the place to buy. So it's the same with the daily chart. We're using these setups to understand where people are going to be moving in or moving out of the name. So, all right, guys, any other questions? Yep, so that's exactly right. On if we go back yesterday to the trade I took on GBR, what you can do, let's see, where is that? Go up a little bit. Here we go. Okay, so right in here, you have the option. See, I wrote 200 right there. That's display. So that means even though I'm selling maybe 2,000 shares, I'm only showing 200. Now on stocks that are thinly traded, if you show big orders, it can be a little bit more difficult to get out, especially if you show like 10,000 shares and you show the whole order. Someone like me would look at that as being possible resistance. So what I do to not scare away the buyers, because I want to see continued strength, but I also want to ease my way out of the trade if I'm in with a heavy position, I can show just 200 shares even though I'm selling 2,000. You have to show at least 10%. So it's an iceberg order. You're showing 10% and the rest is hidden. And what you'll notice sometimes on the ask is a 200 share seller, but then you're seeing buy-in going through and it's like 1,000 shares, 1,500, and that 200 shares hasn't changed. And that tells you someone's sitting there with an iceberg. Now think, you could do this with 100,000 shares and show just 10,000. So some of those 10,000 share orders might be even bigger, right? Even those might be an iceberg. This isn't something that I use hotkeys for, because orders will get rejected if this isn't entered exactly right. And it's more important to get out of a trade. And a lot of times it's not going to make a very big difference. But if you're in a heavy position, or if you're in a stock that's fairly low volume like this one, it's not hard for a big seller on the ask to scare away buyers. And then the problem, of course, is that if you have a stock with a big spread, like a 15-cent spread, the difference between selling on the bid and the ask with 2,000 shares is $300. So you want to try to get out on the ask, and so I'll piece out. I might only go out, with 500 shares at a time, only showing 100, and just do 4 orders or whatever it is. Maybe I'll do 1,000 shares at a time, showing 100. So it just depends on how big my size is, how liquid the stock is, how big the spreads are. There's a lot of times where I just bail out, Control Z, and I hit the bid, and I'm out. And we'll see that in the examples where you see me hit the bid and I'm out. That's what I did actually on this one when I got out at 202. See, 202, when I placed the order, let's see, where was it? So right here, let me just go back just a hair. So I'm going to place an order, and it's going to show up as an order for 2, where is it going to show? I want to see what it shows on the time and sales. If it shows my order right here, it should show it at 10 cents lower. It should show it at 192. Man, this is annoying. So this first halt. In any case, I guess it doesn't really matter. I hit the bid. So you can see there, I hit the bid. It didn't even show up here. It just fired off. So the bid price was 92, or was 202. So the bid on my order would have been a limit order to sell at 192, 10 cents below the bid. You cannot hide shares on every route. Some routes won't let you do it. Some will. So that's also something to be mindful of, and it's another reason why I don't have my hotkeys set to hide shares, because orders will get rejected, they won't go through, and then you want to sell the stock. I mean, that's the most important thing if you're trying to get out. So if you can hide shares, that's an option. If you can't, then you don't. So to answer your question about can you see the volume that's going through along with the price of a candle, um, you can see on this volume bar right here, for instance, the amount of volume that's occurring on this candle. So you can right here, and you can also watch it in the time and sales, right here as orders are going through. So those are two places that you can see the volume and the price at the same time. Any other questions, guys? So I simply don't have hotkeys for hiding because the hotkeys will get rejected. When you hide shares, you have to hide in even numbers. So what you choose to show has to be even. So you could hide 1,100 shares and show 200, but you couldn't show 110. It'll reject your order. So if you, by default, make the hotkey, for instance, to just show 10% of your size, if you have 1,600 shares, it'll show 160, your order's rejected. If you have 17, it'll show 170, your order's rejected. It'll only accept 100, 200, 300, 400, 500, and so on. So for that reason, and I don't know what it would do when you're above 10,000 because I haven't done it, but maybe it would show, if you were trying to sell 10,000 shares or 11,000, maybe you could show 1,100. That might be okay, but you can't show like 110 or 112. So the hotkeys, a lot of times, as I scale out, my positions get smaller and smaller. So let's say I sell half of my 2,000 and I sell 1,000. And then I'm like, okay, now I want to sell, half of that on the ask, but I get a partial fill and I only sell 45 shares. Now I've got 955 shares left. So any hotkey that I use that hides shares is going to get rejected. And because of that, I just don't make that a default thing. So what I would have to do is, if I actually wanted to hide shares, I'd have to type it in here. So one of the things you saw me doing is I prepared orders in 3 different montage windows. So I've got orders to sell, say it spikes up to $2.99, and I want to sell right under that $0.50, but I don't want to scare traders or anyone, maybe shorts or whoever's thinking about buying there, from buying. So I hide my order so it's only displayed that small amount. So as we pop up, I'll get out at 99, maybe it'll keep going, whatever, but I was able to get out. So that'll be one of the orders that I have here. And then another one might have been to buy, to add. And so when I'm adding, I don't need to display or hide anything. I can just go in with what I want. And then another one might be to sell partial position, like 1,000 shares. So the market has been super strong, as we know, the last week and this week. Hopefully we'll see that strength continue. I'm just so impressed with the way trading has been. The momentum has been awesome. So very, very fun, extreme, lots of extreme setups. And we'll get back at it first thing tomorrow. And then, of course, tomorrow we'll have our first class as we get into intraday patterns. So starting to get into some of the meatier stuff that you guys are going to be pretty excited about. I know a lot of new traders. All of this stuff is super important, although you're probably going to be excited to get into the patterns and the strategies. So that'll start tomorrow and then continue as we go into next week. All right, guys, any questions, again, feel free to email me, ross@warriortrading.com.